almost 40% of software stocks that we have right now, maybe even more, are completely unprofitable. Companies borrow more debt, 10 more times in interest expense. These companies will start going bankrupt one by one. These companies will not be able to pay their debt holders. To invest in Dogecoin, this is not real investing. Why we haven't crashed earlier? Why the indexes, why the stock market was still going up almost every single time? As soon as we dip 1-2%, everyone is like, buy the dip, buy the dip, buy the dip. Where they get all this money from? Why the stock market hasn't crashed? And for this reason, I think I have at least 2 reasons why I think that the stock market was still resilient for the crash. The first reason was very low earnings expectations. Let's say so we have company A and it says, okay, in quarter 3, we're gonna make $10 per share in earnings. Okay, our EPS is gonna be $10 per share. But then they're gonna see, okay, now we have chip shortages, now we have like huge unemployment, now we have the pandemic, so not too many customers. Let's revise this and make the lowest estimations possible. Now, let's say that we're gonna be making $5 per share. And as soon as the earnings come, it's gonna be way easy, it's gonna be extremely easy for them to beat these expectations. So $10 per share down to $5 per share, and once again, this is just a theoretical example, it is twice easier to beat these $5. I guess you can understand this, I guess you can agree with this. For this reason, 94% of technological companies, for example, coming from this graph, they were able to beat their expectations, and the lowest was materials sector, which is still 72% of companies were able to beat their expectations. So, and obviously when you see that every single earnings season, almost every single company beats their expectations, everyone is like, okay, so market is good, market is in good condition, everyone can make money, we are good to go. And the second reason for why the market still hasn't crashed, it is because there are so many buybacks. Companies, once again, if you remember back in the beginning I mentioned that there was so much money, so easily affordable money that some companies didn't even know what to do with all this money. They were using this money to buy back their own shares. And obviously as soon as the buyback happens, as soon as even buyback is announced, it usually sends the share price up. Because now there's a fewer number of shares in circulation, which basically means that every single shareholder right now is less diluted, which basically means that every single share right now is more valuable. And this is what sends the share price up during share buybacks. But they have any influence, let's say so, on the business operations of the company. Literally the only reason why the company do a share buyback is to increase its own share prices. And who is the one who is approving share buybacks? Obviously, the board of directors, executives, the ones who are the major shareholders. So, this is one of the ways they are increasing their own wealth. They had 1 million shares, each share is like $30 per share, they have approximately $30 million in shares of their own company. And they're like, okay, so we already beat expectations, we're kinda growing at some kind of pace, 5-10% per year, whatever. How else can we make ourselves more rich? Let's do share buybacks. So they do share buybacks, and now the share prices are up to like $40 per share. So now just because of this, now their net worth increased by like $10 million instantly. This is obviously just over-exaggerated situation, but it's just the way I see it, and I hope, and I'm almost certain that this is the correct thing to look at the things. Okay, and so because of all these things, the stock market got extremely overvalued. So obviously there is no way to deny the fact that the market was extremely overvalued, and one of the things to look at this is by looking at Buffett indicator. So some of you might have heard about this, that the Buffett indicator is basically the relation of the total US GDP to total US stock market, or I mean total stock market to the US GDP, vice versa. But this is the immature, let's say so, way of looking at Buffett indicator. What's more appropriate is when you're taking into consideration total stock market value, total stock market capitalization of entire world, and total GDP of the world. This is when it means, because obviously US market is extremely overvalued, while let's say so, I know, European market, London, like stock exchange or whatever, like this market, for example, theoretically is less undervalued, which basically means if you look at Buffett indicator according to the US market, yes, you'll be like, okay, everything is overvalued. But when you add everything together, this shows you a much better picture. And as you can see, Right now, this very moment, the Buffett indicator shows that stock market is 202%, not right now, but at the very peak, is 202% of the value of the entire world's GDP, which is just insane. Stock market is twice more expensive than entire GDP of entire world. This has not even been like this during dot-com bubble. So as soon as it reached 200%, it started going down, which was most likely not technical analysis related U-turn or whatever, because everyone just realized it was overvalued market, but this finally happened. But as soon as some companies started going down, crashing, entering correction zone, some of them they became in the even bear market, some of the companies, some individual shares, we still saw that the entire stock market or some separate indices like S&P 500 or Nasdaq or Dow Jones, they were still going up. And I would say and you might say why companies start to go down? Why we start making a U-turn, but indices still go down? As you can see from this slide, even though Nasdaq as an index as a whole was still going up, its members, individual companies and individual stocks, 35%, only 35% of them remained above their 200 moving averages, which basically means that 65% of companies were already entering the bear zone, the correction zone. Some of them they went into crashing. Just 35% of the companies that are still surviving, let's say so. And these 35% of the companies, these are the ones that usually are the biggest ones, the one that kept the index as a whole relatively going up in the uptrend, or at least relatively flat. And yes, indeed, this is confirmed. So as you can see at this slide, approximately 21% of S&P 500 is represented in just 6 stocks in FANG plus M. So in the Facebook, which is Meta, Amazon, Apple, Netflix, Google, and Microsoft. 21% of entire S&P 500, which is once again 500 biggest US publicly traded companies, 21% of this is represented in these 6 companies. If I'm not saying Facebook, Amazon, Apple, Netflix, Google, and Microsoft, yes, 6 companies, 21%. So obviously, as soon as these companies stay afloat, as soon as these companies still go up, as soon as they do not fall, the indices will most likely not fall as well. And basically that's exactly what happened. So companies, other companies, smaller companies that are already going down, they're all crashing already, but because these companies, they are still good, they're still meeting the expectations, making money, the share prices are going up, they're still not crashing. And because of this, even though this is just 6 companies and the rest 494 companies which are not that much known, that are not as big, they were going down, but these 6 companies, this is what kept the indices at least relatively flat. But eventually, as you can see, almost up to 56% of the S&P 500 companies went down more than 10% since May of 2021, which basically means more than half of these 500 companies that are already in the correction zone, while still indices were relatively flat. And it all went just until one of these big companies crashed. All we needed to wait for is for one of these giants to slow down its growth, to collapse, to anything else happen to these companies, because they're so big. As soon as one of them goes down, the index, the S&P 500 will feel it 100%. The index will feel it and it will go down, or maybe at least not as much as the company itself. So obviously if Netflix falls 20%, we will not see S&P 500 dropping 20% at the same day as well. But all it took was just one company. So Netflix slowed down its growth of new users. So the company was attracting new users, but it is so much more harder. It's so much harder to keep the growth pace when you're a giant. So for example, in the beginning, when your revenue is only $1 million, in order for you to achieve 40% growth, you only need to make $400,000 more, which is a lot of money, but still 40%, which is a huge growth, it's only $400,000. But when your revenue is $1 billion, the same 40% is already $400 million. This is so much more harder to achieve. So, and Netflix obviously one of these companies, which is Titan, which is a giant, which is a colossal company, which cannot grow at these rates, because some crazy cultists, YouTubers, Kati from ARK Invest, they think that companies can grow at like 70% indefinitely, which basically means, according to her, it feels like that by the year of 2030, every single family in America will have like 7 Teslas. So it's like population of America is 300 million people approximately, but in 2030, like 8 years from now, there will be 1 billion Teslas in America alone. So this, and she says these things with like poker face, with straight face. Yes, there will be 1 billion Teslas by the end of 2035, and this is just a ridiculous thing to say. Obviously, the growth of these companies will slow. This is what happened with Netflix. And what I see, like these companies, these share prices they go high, basically unstoppable. They do not stop. The way I see it is like this slingshot. The harder you pull down the stone, the faster, the more painful it will be to get hit by the slingshot, by this stone. So if you just pull your slingshot just like this, the stone will just fall and that's it. You will not hurt yourself. But if you pull it all the way and hit some person in the stomach or whatever, it's gonna leave a bruise. And this is exactly what happened with all these share prices. These stocks, some particular stocks with like Teslas, I know, Netflix, Google's, whatever, like all these MC, GME, they were going up so much and so unstoppable that this was pulling down the slingshot so much, because that's it, people who are already invested, they want to take their profit as soon as possible. All they need is something bad. Slow down in growth, less subscribers, like decrease in revenue, or like not meeting their projections, lowering future expectations. All they need, because they already got like 200% return, and all they need, because they want to take profits, is just one small bad news.